Another example here with the Russell 2000 ETF. During the uptrend, there's an interesting candle with a long lower wick and higher volume. It's not quite a hanging man or a bull hammer. It serves as more of a counter to the gravestone doji that did not begin a larger downswing. These three bearish reversals, on the other hand, managed to reverse the market without delay. In contrast, these three bearish engulfing patterns managed to reverse the market back down without delay. Lower wick rejections that form counter upswings form a rough support range. These are certainly no morning star reversals, however they have some analogous features, beginning with the first candle in each reversal being a larger red-bodied candle continuing on the current downswing. The second candles have comparatively smaller real bodies that have varying degrees of overlap with the real body ranges of the first and second candles, and in some cases there are minor gaps between the candles as well. The third candles are green to move higher, however they are closer to bullish engulfings rather than the third candle that gaps up in a morning star. A firm lower range forms, and the market is eventually able to return back up to previous high ranges with the current gravestone doji. This is quite normal as the market nears previous resistance, and the next candle confirms this bearish sentiment increasing with a strong close lower. In fact, this is another 3-candle reversal pattern, an evening star, which has some nice clear gaps between the real bodies of the candles, and the gravestone doji again serves to represent the deliberation and minor indecision for the second candle as the market gradually shifts from the prior green uptrend to a more bearish tone. The first and third candles are also relatively symmetrical and clearly larger than the real body of the second candle, very close to the theoretical diagrams. Red volume increases along with a close below the low of the evening star for a likely downtrend. These features are indeed very clear and close to theoretical diagrams, with gaps between the real bodies and this strong close lower. A downtrend does develop, but it slows quite quickly with the market moving into a more neutral range, and that is partly due to the decreasing volume closer to May and the emergence of slightly more bullish sentiment. A return back to the longer-term context clarifies the situation because the sloping upward range seen earlier effectively creates an ascending triangle, and that breaks out over the major resistance to newer highs. This again highlights the importance of avoiding tunnel vision and purely focusing on candles in the short term without taking into account the broader context in the market. And it is a familiar sight with the break over the firm upper 150s resistance, not with exceedingly high volume but exceedingly consistent volume. A new upper range forms and is held down by a series of bearish engulfing patterns again. This first one is not completely engulfed, but it is very close and still demonstrates the general price action, and it also helps the market to be held down by larger increases in volume at these downswing points. Those periodic red spikes are not frequent enough to initiate a sustained downtrend, and the market continues up for a short time longer, where we see familiar resistance and reversal candles. At this point, the market is slow to begin a bearish reversal, with relatively normal volume heading into September, and the candles unable to strongly close below the initial bearish star. However, once red candles and volume increase in frequency and quantity into mid-September, we see a characteristic acceleration downward once again. The upper 150s range reverses roles from a major resistance to a major support for this large downtrend, and demonstrates another case where a major support range does not lead to an uptrend, but rather shows a secondary characteristic of support in slowing down the strong selling pressure. A flat base forms at the established mid-140s support area. This is neutral to slightly bullish, mainly due to the Harami and Doji. It's certainly no morning star, however it has some similar price action in that it is a candle of deliberation in between two larger real-bodied candles. The minor upswing is naturally repelled by the firm upper 150s range, now acting as resistance again. This upswing is more of a minor rise, following the overextension downward from the rapid selling, mainly in the last push below the upper 150s back here. This is further evidenced by the minor upswing that currently also has low volume. It is a relatively easy move back up, not because the market is exceedingly strong in a bullish context, but rather the market is extremely weak in a bearish context due to the overselling and overextension, mainly in this highlighted red area. So this can be more of a passive rise in that the market isn't actively being bought up in large quantities, but rather it has been oversold and the selling pressure has subsided significantly. A familiar sight with the neutral to slightly downward sloping range, having reversal candles form at the lower boundary near the mid-140s to slow down the continued drop. In the short term, there is strong bullish pushback with these clear bull hammers maintaining contact with the mid-140s support range. The market is able to close under this strong support area as volume remains consistently above normal to close strongly lower. A downward continuation is much more likely at this point. As expected, the market begins to lose contact with the strong mid-140s support range, and this red inverted hammer is a bullish candle on its own, but given the context, it has little chance of reversing the overwhelming downtrend unless there is a strong close above back into the mid-140s immediately. This does not occur, and instead there is the familiar continuation to the downside seen in previous examples. In addition to the familiar price action of a downward continuation in the same general outline as a falling three methods pattern, notice that there is strong red volume during the initial spike down, and the volume decreases during the resting phase and increases once more as the formation completes. The upswing that begins 2019 is stronger than the one seen in November 2018, with more consistent green volume closer to normal levels. However, there's also an element of a passive rise here, as the market is also able to easily regain the lost ground due to the near absence of selling pressure following the final overextension downward. Simply looking at the transition of color into 2019 sees a near absence of selling pressure aside from these four candles that appear in the first few weeks of 2019 that have little effect on the increasingly steep uptrend. On closer inspection, the upswing turns out to have features of multiple candle patterns. It has price action similar to a morning star in that the first candle is a large red candle, the second a smaller red real-bodied candle, and the third a larger green candle to begin the new uptrend. However, there is significant overlap of the real body ranges of the second and third candle. but not enough engulfing to be a bullish engulfing. Rather, it is more of a heavily overlapping kicking pattern. It is the overall price action of a gradual shift from a strong downtrend to a stable uptrend. And similar to a morning star, there is a preferred sequence of volume in that the first and third candles have higher volume in comparison to the second candle. Like other examples, one of the first major obstacles is the lower boundary of the resting phase from the prior downward continuation. Technically, an evening star did form here, however, it wasn't too symmetrical in terms of the gaps between the candles. Also, the second candle showed less upper wick rejection with a higher close above 146.92 for more bullish intent, rather than being more neutral to bearish as a second candle of deliberation for a possible downswing. Volume was also at normal to slightly below normal levels before, during, and after the morning stars formation. Volume was also green for days at a time, and it also increased at some points. This all resulted in a relatively stable push over the final resistance level in this range to reach higher prices into the 150s. A steep but steady rise as the market remains consistently green to reach the next major obstacle in the upper 150s. As would be expected, there is resistance upon contact with this major obstacle, and this begins with a harami followed by an evening star. Overall, it is symmetrical with higher volume for the first and third candles in relation to the second. There are also adequate gaps between the candles. The only glaring imperfection from theoretical diagrams is the third and first candle are not significantly larger than the second candle. But this is a minor discrepancy between theoretical diagrams and real-world circumstances. It is also good to see minor upper wick rejection with the second candle to show a slightly more bearish sentiment developing. This forms the classic gradual U-shaped turn an evening and morning star tend to produce. The following candle manages to trade below the evening star's low, however it is green and subsequently closes back above the close of the third candle. Thus, the tone is slightly bearish, but there may be a delay to the proposed downtrend. As expected, there is a delay in forming a possible downswing, and the market exhibits some persisting bullish sentiment as these lower wick rejections indicate the market was unwilling to push lower in the short term. Then the current large red candle renews the bearish sentiment as it also has increasing volume. Similar to other examples, there is a timely increase in red bearish volume with stronger closes lower to initiate a stable downtrend. This upswing in early March is a cross between an unsymmetrical morning star and a bullish kicking pattern. And the second upswing draws heavily from the support around the mid 140s to make this spinning top appear in a bullish context. Certainly no piercing pattern with the previous large red candle, but it is showing lower wick rejection near this major support. The upper 150s remain a contentious area, and similar to prior downswings, there is a delay to a possible downtrend due to a bullish rebalancing as several candles continue to close at or slightly above the resistance range. A familiar sight as the levels marked out continue to have major influence in the market, and in fact, they form a major confinement range within the area from the upper 150s to mid 140s. Another case where a spinning top, similar to a doji, can be found in a directional context, as it shows upper wick rejection with the established upper 150s resistance. This also forms a less strict harami and an overlapping bearish kicking pattern. This is not a morning star due to the greater overlap of real bodies. However, it does have the same general U-shaped price action, and when all three candles are combined, they form the general price action seen with a dragonfly doji or bull hammer. Similar to the bull hammer seen at the beginning of August here, there is lower wick rejection from that combined candle. No morning star, however, it does form a base of support at the established mid 140s along with the minor upswing before and after. That all combine to give a good foundation to the market in rising back up to the upper 150s, where there is currently a bearish star. It is a green candle that follows to trade lower, and it is a bearish star to maintain the bearish context. After a minor delay, the consistent selling volume allows the market to begin an early downtrend that results in a classic surge back to the established mid 140s support, where once again there is strong lower wick rejection, and interestingly, when these two bearish stars are combined, they form one big green bearish star. A very bullish situation to begin October, with the green bull hammer bullishly engulfing the red one before it, and even though there is a minor drop, it forms a double bottom in the medium-term context to initiate a strong uptrend that has consistent green volume rather than a series of large green spikes, and this is enough to propel back up towards the upper 150s, effectively demonstrating another case of a more passive rise in that the selling pressure has almost been completely absent here after the overextension from the final drop lower, and that allows the market to climb without major spikes in green volume. Here there are bearish reversal candles as would be expected. However, note how most of the real bodies begin to close higher within this resistance range. A sideways range is a familiar sight that can delay a possible downswing. This large green candle adds an extra boost with its increased volume to decisively break above the firm 150s. After that, there's a minor evening star to form a minor downswing that acts as the typical consolidation where the market retreats back from its new high back towards the previous major range that provides support to the continuing uptrend. Interesting to note that this is not only an unsymmetrical evening star, but the first candle is a gravestone doji to give a more bearish start to the pattern. This is also a less strict evening star, considering that the wicks overlap each other, and that is not much of a problem as the general U-shaped price action is still there, and the following candle closes strongly lower. A bearish engulfing pattern has little effect on the overwhelming uptrend, especially with the shorter-term bullish boost to begin 2020. Though the market still remains under pressure from a dark cloud cover pattern that soon emerges, and this time there is requisite immediate follow-through, quick confirmation with this candle gapping and closing lower, with increasing selling pressure as well in the volume, and that results in a rapid decline. There is a slight increase in bullish volume, however this still does not counter the strong bearish sentiment in the longer term, as dark cloud cover emerges multiple times, along with several other reversal candles that effectively form a double top in the short term and a sloping triple top in the long term. This of course leads to a major decline once more when the market accelerates to easily breach the upper 150s range. In the short term, the market is oversold, and this is evidenced by multiple inverted hammers, which show some minor intent to rise back up for a brief period, but the overwhelming long-term context still shows a massive decline that is ready to continue after a successful breach of the 140s. Later on, there is a candle that is unusually green, but this still goes into the bearish context as it closes below the key mid-140s support range, which, like the upper 150s, did slow down this massive decline for a short time. Focusing on the general price action and broader context is much more sensible than just paying attention to the current green candle. Indeed, the longer term and general bearish context of this downward continuation does complete, and that easily overcomes the minor doubt with this single green candle. More bullish candles appear with longer lower wicks. The market can be considered overextended as there is a declining amount of selling pressure and an increasing bullish sentiment, especially with the current bullish engulfing pattern. Downward overextension can be considered now as the market decreases in overall selling pressure and the additional bullish sentiment with the current bullish engulfing pattern. Volatility remains high, and the next two candles are red, but they trade over the bullish engulfing's high and manage to show lower wick rejection to establish a firm lower base. This weakness and uncertainty for a slow start to the new uptrend is quite normal, especially in a situation like this during a major global and volatile market decline, where fast single candle reversals are much less common. Some evening stars appear during the development of the uptrend. There are clear gaps between the candles, however it is strange to see the first candle during an uptrend being red, and there is some asymmetry in terms of the size of the candles, where the third candle is the smallest and the second and first candles are relatively larger. The uptrend does stabilize, and that is a reason why these downswings don't take down the market too significantly even when volume increases. Even though there are longer wicks and more overlap of the wicks, this evening star still shows the general U-shaped price action, and this leads to a slightly stronger downswing due to this appearing in the established major resistance area. Overall, this is another example of a more passive rise. There is consistent green volume at times, however, it is never exceedingly high, and it is more of an absence of selling pressure that is due to the downward overextension, particularly during this last phase, which again was such a strong drop. It was able to counter the strong bullish context of this morning star forming at a major support range with high volume. Whether it is a downtrend or an uptrend, the market can't sustain a steep trajectory for so long, and that is what leads to an overextension. That is in sharp contrast to a more stable trend with minor fluctuations to keep the angle on a more stable trajectory.